Hello, welcome to the Chapter 3 lecture. So let's get started. We're going to be talking about the adjusting process. The accounts need to be adjusted at the end of the period, the end of the reporting period. Why? Why does the accounts need to be adjusted? So before we can prepare financial statements and publish them to the internal and external users, adjusting entries are necessary because of the accrual basis of accounting. The accrual basis of accounting, we talked a little bit about in, I believe, chapter 1. The accrual basis of accounting requires that we record all of our revenues when we've earned them, not necessarily when we've received them in cash, but when we've earned them. And we've got to record our expenses when we've incurred them, not when we've paid them, but when we know we have an expense, then we have to record that expense. And sometimes we also say that's the matching principle. We match our expenses with our revenues. If we've got the revenue reported on our income statement, then the expense that goes with that revenue needs to be reported on the income statement as well. So before we prepare our financial statements, we've got to make sure that that we've brought the books up to date, that we've recognized all the revenue that needs to be reported on the income statement, right? Because that's the accrual basis of accounting, that we've recognized all of those expenses that need to be reported on the income statement. So the accrual basis of accounting means that we've got to accrue the revenue and accrue the expenses, right? To bring our accounts up to date so that our financial statements are accurate and consistent with generally accepted accounting principles. Unlike the cash basis of accounting, where we don't really care whether we've earned the revenue or whether we've incurred the expense. If we have the cash, then we've got to report it. That's what the cash basis of accounting is. If you've received the revenue, right? If you've got the cash, well, then you report it, right? If you haven't received the cash, then you don't report revenue. Same thing with expenses. If you've paid the expense in cash, then you report the expense. Even if you have an expense and you haven't paid it, well, in the cash basis of accounting, you wouldn't report it, right? Cash transactions trigger the cash basis of accounting. If you don't have a cash-based transaction, if you haven't received the cash or paid the cash, then it's not a transaction and we don't record it under cash basis of accounting. But GAAP, right? Generally accepted accounting principles. Generally accepted accounting principles require the accrual basis of accounting. So we've got to stick with GAAP. And because of GAAP, we've got to make sure that we bring all of our accounts up to date so that our financial statements are useful and meaningful. So we are applying the revenue recognition principle, recording those revenues when we've earned them, right? When we've done whatever it is that we were supposed to do, when we've performed the service or provided the products, right? If we've performed the service or delivered the products, then got to recognize that revenue, right? That's the revenue recognition principle. And the expense recognition principle, that means that, we've incurred some expense, right? We're obligated, right? We've incurred this expense in generating the revenue, right? And so we've got to recognize that expense. That's also called the matching principle, right? So even if we haven't paid the expense, if we've generated this expense in generating the revenue, then the expense has to be matched with that revenue. And so the adjusting entries are necessary to bring all of our accounts up to date. Let's talk about the kinds of adjusting entries that we're going to be using. There are basically three kinds of adjusting entries. There are the accruals. That's the first thing we're going to look at, the accruals. So accruals mean that we have to accrue the revenue. That's revenue that we've earned that hasn't been recorded. We've got to accrue the expense. That means we've got an expense that hasn't been recorded. So basically, accruals are things that we've got to record that haven't been recorded, like the revenue and the expense. Here's our first example. So an accrued revenue. So there's no recording, right? We haven't recognized any revenue, right? There's no journal entry. So that means when we get to the end of the period, we've got to fix that problem. And we've got to recognize that we've earned revenue, basic entry. That means we're going to be debiting some kind of a receivable and we're going to be crediting a revenue account. That's how you accrue a revenue in an adjusting entry. Again, an adjusting entry is not a correcting entry. We're not correcting anything. We're just bringing the accounts up to date. And an accrued expense, well, there's no recording. We haven't recorded the expense yet. There's no journal entry. So to fix that, right, to bring the accounts up to date, we debit an expense and we credit a liability, like accounts payable. That's how we record adjusting entries for accrued items, the accruals. We are accruing revenue, debit a receivable, credit a revenue. We are accruing an expense, debit an expense, and credit the liability we call accounts payable. Next, the second kind of an adjusting entry is a deferral. So we've got to defer revenue when we've received the cash, but we haven't earned it. That's the initial recording. So in this first illustration, a deferred revenue, we also refer to it as an unearned revenue. That means that in the initial recording, we receive the cash, but it's for revenue that we haven't earned yet. And so we're not able to recognize it as revenue when we receive the cash. So instead, what we do is we debit the cash account and we credit this new account that we call unearned revenue, which is a liability account because it represents our obligation to do something in the future. That's what a liability is, an obligation. So unearned revenue is a liability account that recognizes our obligation to do something in the future. Means we've got to do whatever we need to do it is that requires us to earn that revenue. So we've received the revenue in advance. We debit the cash account, we credit unearned revenue. When we get to the end of the period, and after we've done whatever it is we were supposed to do, provide the product, perform the service, then we've earned the revenue, and now we record it in an adjusting entry. And we move the amounts out of that liability account, debit unearned revenue, and credit the revenue account. Also, we have deferred expenses. That's what we call a prepaid expense, right? That's an expense that we initially defer because we haven't incurred that expense yet. We have nothing to match it with. So if we pay something in advance, right, we've got to recognize that we've paid the cash. By debiting this account, we call it prepaid expense. It represents an expense that we haven't incurred yet, right? We haven't received anything yet for that expense. So technically, it's not an expense yet. So we debit this asset account, right? It represents something that we own. We debit this expense called prepaid expense, and we credit cash. And then once we've incurred that expense, we've used it to generate revenue, then we have an expense. And in the adjusting entry at the end of the period, now we recognize the expense and we move it out of that prepaid expense account, move it out of the asset and actually put it into an expense account, debit the expense, and we credit the prepaid expense. These are examples of the deferred items, right? We are deferring the revenue, and then in the adjusting entry, we recognize the revenue. We are deferring the expense, and then in the adjusting entry, we are recognizing the expense. So we've looked at two different kinds of adjusting entries, the accruals first, now the deferrals, and now we've got some examples with some numbers on them. So let's talk about the accrued revenue. This is an example of an accrued revenue. So this company, they have provided services and they've done whatever it is they were supposed to do. You know, they provided the services and they've earned the revenue, but they haven't received it yet. So at the end of the period, we have to adjust, right? We've got this adjusting entry at the end of the period. So when we adjust, again, we debit the receivable and we credit the revenue, right? Debit accounts receivable, credit the fees earned account because we've performed services, 25 hours worth of services at $20 an hour. That's what we've earned. Right. And now the accounts are being brought up to date with the adjusting entry. So we debit the receivable and we credit fees earned. That's our adjusting entry for accrued revenue, right? We are accruing, recognizing revenue that we've earned, haven't received it yet. That's why it's in a receivable because we haven't received it yet. We don't have the cash, but this is accrual basis accounting. So we are accruing for the revenue. And here's an example of an accrued expense. So we've incurred this expense, haven't paid it yet, but we have an expense. So we've got to bring these accounts up to date. So we've got some wages, right? We've got some wages. We recognize that we've got weekly wages, right? Every Monday through Friday, we've got wages of $125 a day we pay our people. 5 days, $125 a day, that's $625 a week. But we get to the end of the accounting period on December 31st, and that's a Tuesday. So now we've got Monday and Tuesday. We got 2 days of wages that we owe our employees. $125 a day, 2 days is $250. We've got an expense that we've got to recognize now for 2 days. Debit wages expense for $250, credit wages payable. We have an obligation. We record the expense, we record the liability. We've accrued the expense. So accrued items. First example of an accrued revenue, now the example of an accrued expense. Next, deferrals. We've got a deferred revenue. So in this case, what happened initially is that we recorded this unearned rent. We recorded $360 of unearned rent because we received it, right? We received the cash in advance. And so we recorded this unearned rent. So the initial entry was to record the unearned rent. And because it was unearned, we put it in a liability account, unearned rent. And you see that $360 that we received in cash going into this liability account for 3 months, $360 for 3 months of rent. And now we get to the end of the month. We get to the end of December, and we've got to recognize, well, we've earned some of that rent, right? We've earned 1 month of that rent. We put 3 months rent in this account on December 1. Now we get to December 31, and we've earned one of those 3 months. We've earned 1 month of rent. So now we've got to reduce this unearned rent account, this revenue account, and recognize the rent that we've earned for 1 month. So we debit this liability account for 120 and we credit the revenue account. All we're doing is we're moving $120 of rent, which represents 1 month, out of the liability account into the revenue account to bring these accounts up to date, to recognize and report that we've earned 1 month of rent. See, we received all the cash up front, the entire $360 in cash up front, but we haven't earned it. So none of it initially goes into a revenue account. All of it goes into this liability account called unearned rent. And at the end of each month, for 3 months, we're going to recognize 1 month of this rent. And here's the first month. So that's a deferred revenue. Initially, we defer it into the liability account. And then at the end of each month, we're going to go ahead and recognize 1 month of rent. Now, let's take a look at a deferred expense. Good example of a deferred expense is prepaid insurance. With prepaid insurance, what's happening is kind of self-explanatory. We are paying for the insurance in advance. It's prepaid, which is what you have to do in most cases with insurance. Pay for it in advance. You don't pay for it after the fact. After you get it, you pay for it in advance. So we are paying for 12 months of insurance. We're paying $2,400 for 12 months of insurance, and we haven't received any benefits yet. So on December 1, we put all of that $2,400 into this asset account called prepaid insurance. And here it is, right? Prepaid insurance, we put it in this asset account. $2,400 goes into that asset account. But then we get to the end of the month. We get to December 31st, and now we've received the benefit of this insurance for 1 month. 1 month of insurance we've received benefits for. So now we have an expense for 1 month. So all we're doing is we're putting 1 month of insurance into the expense account and taking it out of the prepaid account. 1 month. All that is the 2,400 divided by 12, right? Because $2,400 is for 12 months. 2,400 divided by 12 is $200 a month. So we take $200 out of the prepaid insurance and we put it in the insurance expense, debit insurance expense and credit prepaid insurance. That's a deferred expense, an example of a deferred expense. And the third kind of an adjusting entry. So let me just summarize. We've talked about two kinds of adjusting entries: the accruals, accrued revenue and accrued expense; the deferrals, deferred revenue and deferred expense. And then the third kind of an adjusting entry is for depreciation. We've got to record the depreciation. Well, what is that? Well, when we buy assets, when we buy these assets that are called fixed assets or assets that have a life beyond a year, well, what happens is because those assets benefit multiple periods, we take the cost of that asset and we put it in an asset account, a long-term asset account. And good examples of these fixed assets are something like land and office equipment, right? Those are fixed assets, right? So those fixed assets go into a long-term account. an asset that we call land and an asset that we call equipment. And what happens is some of these fixed assets, these long-term assets, some of them start to decline in value. And so this process of depreciation is where we attempt to take the benefits that we receive from an asset and spread those benefits over the life of the asset. So we receive these benefits from an asset typically in the form of revenue. For example, if you buy equipment, well, that equipment allows you to provide services or to produce product, and you earn revenue. And so we have this expense that's associated with the office equipment that needs to be matched with that revenue. And this process of matching the expense with the revenue is this process of depreciation. That just means that we're taking a portion of the cost and assigning it to an expense account over its life. So, for example, if you buy the office equipment that costs you $1,800 and that office equipment has a life beyond a year, then you want to take the cost and spread it over whatever that life is. So, if you buy a truck that costs you $10,000 and you have use of that truck for 10 years, well, technically that $10,000 should be spread over 10 years, $1,000 a year, right? That's the expense that's related to that truck. And you need to spread that $10,000 over 10 years, not recognize all the $10,000 in 1 year, but spread it over 10 years. Well, that's all we're doing here. We're taking the office equipment of $1,800 and we're spreading the cost of that equipment over its life, over the period of time over which we expect to receive benefits. And the expense that goes with this office equipment is exactly $50. $50 for the month of December. So when we record depreciation, well, the entry is going to look the same every time we record depreciation. We're going to debit an account we call depreciation expense and credit an account that we called accumulated depreciation. In this case, depreciation expense and accumulated depreciation for this office equipment is exactly $50. So now again, we're bringing our expenses up to date in an adjusting entry. And typically, if we were also looking at the balance sheet, on the balance sheet, you would see the cost of this asset, the original historical cost of the asset at 1,800. And then this new account called accumulated depreciation it's an offset account. Technically, this account is called a contra asset account, a contra asset account. So, when you look at this accounting equation, we have assets, right? Has to equal the liabilities plus the equity. And now we've added a new account called a contra asset account. Any account that has that title before it, this contra, any account that is called a contra account means it's some kind of an offsetting account. So if it's a contra asset account, that means it offsets another asset account. If it's a contra liability account, it's going to offset another liability account. If it's a contra equity account, it's going to offset another equity account. Now, this accumulated depreciation account is a contra asset account. It's going to offset this equipment account. Equipment is the asset account. Accumulated depreciation is the contra asset account that offsets equipment. So offset means it reduces the account, right? So that the book value or the carrying value of the equipment is $1,800 less the contra asset account of $50 or $1,750. This is how you would see it reported on the balance sheet. This would be the balance sheet presentation. And I have kind of a summary sheet that ties it all together. So when we look at all these adjusting entries, these are all of the different kinds of adjusting entries that I've talked about. So the first kind, right, we've got three different kinds of adjusting entries. We've got the accruals, accrued revenue, and accrued expenses. And here's what you do. You accrue the revenue, debit the receivable, credit the revenue. You accrue an expense. You debit an expense, and you credit the liability. The deferrals is the second kind of an adjusting entry. What do? Well, initially, right? Initially, we defer this revenue that we've received into this liability account. And in the adjusting entry, here's what we're interested in. In the adjusting entry, we record what we've earned, right? Debit the liability, unearned revenue, credit fees earned. a prepaid expense. Initially, when we pay an expense in advance, we put it in an asset account, like a prepaid account, debit, and we debit that asset for the prepayment. But then when we've incurred the expense, now we've got to move it into an expense account, debit the expense, and we credit the asset account called prepaid insurance. And then the third kind of an adjusting entry is the depreciation. And it always looks the same: debit depreciation expense, credit accumulated depreciation. So those are the three kinds of adjusting entries that we're looking at in chapter 3. And next, we're going to be moving into our problems for chapter 3. That's it for now.